validated. Overnight, 86% of the currency in circulation was cancelled. The goal? To deal a financial blow to the black economy. A year later, was it all worth it? Watch the demonetization experiment on the 8th of November with Ira Duggal, only on Bloomberg Quint.
Good morning. This is Bloomberg Quint Live. You're watching Indian Open, and I think I stole your line, Neeraj.
No, that's okay. As long as one of us says it. But yeah, good morning to Ira, good morning Minka, good morning viewers as well. I'm Neeraj Shah.
Good morning, everybody. Let's get down to the headlines. We've got crude oil prices touching a 28-month high as the purge in Saudi Arabia rattles markets. US President Donald Trump heads to South Korea, where Kim Jong-un and trade disparity are expected to dominate talks. A healthy product mix is expected to help Cipla perform better than its peers in the second quarter. And HDFC Standard Life's 8,700 crore IPO opens for subscription today.
Need I say more? It's probably all about crude, but I must say that the global markets, the global equity markets are actually starting off or looking to start off on a pretty decent note. Maybe the handover was strong. The rest of the Asian pack is not doing all that bad. So bring up the global market picture firstly, and you will see a sea of green out there, quite frankly. SGX Nifty stated to start up, indicating that we'll start off above 10,500. So these are strong levels to watch out for in the session today. Let's see if we hold on or manage to hold on to these levels, because both from a perspective of the macro cues, and we'll talk about crude in great detail in just moments from now, but also in terms of how trade shaped up in the second half of trade, we did come off quite rapidly. But yeah, crude will remain the dominant talk, 3.5% in overnight trade as well. Brent above 64, WTI above 57. We'll speak to experts about whether there is more in store. I think it's difficult to say, but let's try and still figure out what is the expert view out here. If indeed this continues, then aside of course, what happens to specific stocks and all of that, there could be some concerns that could come in from a macro perspective, and therefore the markets might take cognizance of that as well. But let me not delay this too much. 3 or 4 stocks that I just quickly want to mark. Watch out for ONGC. Slightly poor results did not dampen the spirits here. There is this tailwind of crude. The stock is at multi-month highs. I think the highest levels since Feb. These are so 8-month or 9-month highs that ONGC is trading at, very close to 200 odd. Let's see if this further rally in crude gives some more tailwind to this big boy. It's been on a strong move. Let's see if there is further upticks in today's session or no. And I thought 2 or 3 numbers stood out, quite frankly, aside of all the key stocks in news that we'll talk about. But Torrent Power, very strong EBITDA numbers that came out. Similarly, for Gujarat Industries as well. So both of these could be interesting stocks to watch out for. And I've picked up TRF specifically. It's been a stock in the eye of a storm for the last 3 or 4 years for various reasons. These numbers will leave a lot to be desired. Negative EBITDA. It is on its day a very, very volatile stock, and therefore do watch out for this one as well. But I dare say crude and crude impacted stocks could well be in focus. So watch out for ONGC, HPCL. They were the dominant trades on the index yesterday. They could well be dominant trades on the index today as well.
All right, let's take a look at what we have confronting us in terms of crude prices. The recent arrests in Saudi Arabia, these took place over the weekend, that is on Saturday, and they have lent sort of a leg to the crude rally. Crude prices at a 28-month high, with Brent trading comfortably above that $64 a barrel mark, whereas WTI is back above the $57 mark. So will prices stay here? Well, joining us from Singapore now is Vandana Hari of Vanda Insights. Vandana, hi, good morning. Thanks for being on Bloomberg Quint. This obviously seems to be prompted by the events that took place in Saudi Arabia over the weekend. And whilst this could be termed as a knee-jerk reaction, do you think it might have some staying power?
Good morning. So, yeah, quite right. The $1.70 to $2.20 increase in Brent and WTI futures overnight can very specifically be ascribed to what happened in Saudi Arabia over the weekend. I would agree it is a knee-jerk reaction. However, the downward correction might be a bit slow. I think there has to be one because I do believe that it's a bit of a panic buying right now. Whatever has happened, it's essentially the Crown Prince Mohammed bin Salman consolidating his hold on power. He has been the one essentially directing and dictating the kingdom's oil policy, whether it's with regards to OPEC cuts or the Saudi Aramco IPO. So in that sense, nothing has changed. But of course, given the scale and the suddenness of the operations over the weekend, it's understandable that the market, which was already feeling extremely bullish, went into a bit of a panic buying mode.
Vandana, we've also seen some supplies come off the market, which is adding to the sense of tightening, confronting crude prices. Do you expect this to be a seasonal situation, or do you think all the conversation that the OPEC's been having with Russia and otherwise will take crude prices to $70 in the near term?
The mopping up of the excess supply and the decline in the inventories is partly secular and partly seasonal. Secular because OPEC, non-OPEC cuts, as we know, since the start of this January, they didn't really have the desired effect in the first half of the year. But they have started showing up in inventory drawdowns since the third quarter of this year. That was a report from the International Energy Agency last month, and it'll be much awaited. The latest figures will be awaited later this month, which are likely to show continued drawdown in stocks through the third quarter. Now, as we go into the fourth quarter, this is where the seasonal aspect comes in. It is traditionally a high demand season, and we are particularly entering the season with a relatively lower distillate inventories, refined product inventories in general, than what was the case in the past 2 or 3 years. So those are factors that have led, even before the latest Saudi development, to a lot of bullishness in the market. And talking of supply, one mustn't forget that a very important factor as well is a pullback in the growth in U.S. tight oil output from the shale sector. So there has been a massive recalibration of the market's expectations there as well. So the oversupply situation has been easing gradually through the first half, but quite dramatically in recent months.
Okay, one quick last question, Vandana. I know a few months ago, this would have sounded fantastical, but I'm finally seeing news headlines now talking about $100 crude. Do you think that's a possibility?
I'm afraid not. I think usually when there is a massive shift in prices downward or upward, you do see a few kind of going to the absolute extremes. We had predictions of $20 when it was below 30, and every time it spikes up, you have people talking about 80 and 100. I think 100 is really too far-fetched at the moment. I wouldn't even count on 70, to be honest.
All right, thanks very much. That's always good news for a crude importer like India. Vandana Hari there. Some insights in the crude markets. All right, that's how crude is faring this morning. Take a look at what's on First Word. We look at how the HDFC Standard Life Insurance stacks up against its two listed peers. And with RBI's December deadline looming, companies such as Videocon and Ruchi Soya are busy inking deals to pare down debt. We'll discuss that as well. We also look beyond the numbers at the sectoral trends that emerge from quarterly earnings. So we've got a bunch of things lined up for you this morning. Let's get set with the HDFC Life IPO. Neeraj?
Yes, indeed. So it's all set to become the third life insurer to get listed on the bourses. 8,700 crores offer for sale opens for subscription today, and we'll see two promoters cutting stake in the company. Sumit Sarkar standing by with all that you need to know about the IPO. Sumit, so how much do the promoters stand to make from the IPO, and tell us the other details about this one as well.
they'll make a good amount of money from this IPO. Now, HDFC Standard Life is looking to raise around 8,695 crore rupees at a price band of 275 to 290. Now, at the upper end of the price band, that is 290, the valuations would be around 58,260 crore rupees for the company. Now, this is a complete offer for sale where both the promoters will be diluting their stake. Now, the listed NBFC, that is HDFC, will dilute around 9.5% of its stake and will gain around 27 times its investment done in the company back 17 years. And the UK-based Standard Life will dilute around 5.4% of its stake and will gain around 7% of its investment done in the same period. Now, the life insurer has more individual products in its portfolio and it sells most of them through banks. Now, it has around 125 bank assurance partners which generate around 51% of its new business premiums. Now, the 40% of its new business premium is earned by direct sales, while the remaining from individual agents and brokers.
Okay, how does this stack up against competitors? You've got ICICI Pru that listed much earlier and then SBI Life that came in recently.
Yeah, when you compare HDFC Life to its competitors in financial year 2017, HDFC Life sold more linked plans, that is around 35% of its new business premium constituted of the linked plans, which is lower when compared to ICICI Pru and SBI Life. Now, for an insurance company, it is the linked plan which is more profitable when compared to the non-linked plans. Now, the company's solvency ratio was at around 1.9 times, which is ahead of the regulatory requirements of around 1.5 times, but below its peers. Now, the persistency ratio, which shows that how many plans that the company was able to retain for the 13th month, stood at around 81% for HDFC Life, which is at par with SBI Life but below ICICI Pru. However, for the 61st month, that is after 5 years, the persistency ratio for HDFC Life stood at around 57%, which is ahead of ICICI Pru but again below SBI Life. Now, if you see the claim settlement ratio for HDFC Life was at highest among the private players at 99.2%, and its total premium growth rate was also highest when compared to ICICI Pru and SBI Life. Now, the total premium earned grew at a compounded annual growth rate of 14% over FY13 to FY17 for HDFC Life, while that for ICICI Pru and SBI Life at 10% each. Now, the return on equity for HDFC Life was around 29.4 and 31.2 was for ICICI Pru and 20% for SBI Life. Now, the embedded value, that is the net asset value plus the present value of the future earnings of HDFC for the first half of financial year 2018 stood at close to 14,000 crore rupees, which is lower when compared to ICICI Pru and SBI Life. And again, the asset under management was also around 99,500 crore, lower than ICICI Pru and SBI Life, but the asset under management grew at a much higher rate when compared to ICICI Pru and SBI Life. Now, the asset under management of HDFC Life grew at a compounded annual growth rate of 23% over FY13 to FY17, while that of ICICI Pru and SBI Life at 12% and 6% each. Finally, coming to the valuations, the shares of HDFC Standard Life are offered at expensive valuation when compared to ICICI Pru and SBI Life. At the upper end of the price band, that is 290, the price to embedded value comes to around 4.2 times, while price to book value comes to around 13.1 times, which is expensive when compared to ICICI Pru and SBI Life.
Wow.
All right, that's HDFC Life. That opens up today, so we'll watch what the subscription numbers look like. Just switching focus a little bit. Thanks, Amit, for those details. Switching focus a little bit to the stressed asset space. Last couple of weeks, we've seen some deals starting to get fructified. These are deals which are not the 12 large accounts, but these are deals of accounts which may be in the second list that the RBI wants banks to refer to insolvency unless a deal is reached by the 13th of December. That, of course, is just about a month away, so you're starting to see some deal making happen. Now, we had Videocon announce their deal on Kenstar yesterday. That's something that's been in the works for a while. They finally struck a deal with Everstone, and while they haven't officially disclosed the numbers, the size of the deal is around 1,300 crore is what press reports are suggesting. Ahead of that, you'd had Ruchi Soya, another company which has been reported to be in that second list, also reporting a deal. They sold about 51% to Devonshire Capital. That was a relatively large deal in terms of perspective of the proportion of debt that they have, 4,000 crore, and their debt is about 12,000 odd crore. In Videocon's case, it was a much smaller deal. But just to make the point that, you know, as you're getting towards this deadline of December 13th, you will probably see companies and banks try and avoid finding themselves in the IBC, and hence they will try and strike some deals. I do want to say that the fact that the recapitalization money has come in and banks have that and have the assurance that they will get that, they will probably be in a slightly better position to actually strike some of these deals. And perhaps unlike in the case of Arcom, where perhaps banks felt pressured into getting into a deal which may not have been the best to get into, banks will be in a slightly better negotiating position. We had the SBI MD who was at a FICCI event yesterday, and I think our reporters asked him about what's going to happen to this whole set of companies. And remember, this is a much larger set of companies. It's a list of almost 40, 50, but they don't extend to all banks. It is 40, 50 over and across all banks. So he said we're trying to strike whatever deals we can, and pending those deals being struck, we will, of course, refer them to the IBC. If they go to the IBC, there will be increased provisions at hand as well.
All right, there you've got it. Two interesting deals that take place, all in the effort to avoid insolvency, I would imagine, on both ends.
Yeah, and it's interesting. It's the set of bars that we've seen a bunch of these deals, and we'll, of course, talk to some of these over the course of the next few days as well. But guys, we're talking about earnings left, right, center all through the last few days. It's no different today. Yesterday, we were talking about how it's all been about cost control, quite frankly, in terms of which companies have been able to do well or no. But since we are at the last leg of the earnings season, it's also important to figure out post 3 quarters of the Nifty reporting numbers already. I think the number is 78.8% from the Nifty weightage as to how has the scorecard been. And Darshan is standing by with the scorecard of the second quarter earnings so far and the sectoral trends, if any, that are coming out of this. Darshan, good morning.
Good morning. So 35 Nifty companies have already reported numbers, and if we have the scorecard, you can see majority of the numbers are in line. So out of the 35, 20 are in line, 8 strong and 7 weak. So basically that's the broad scorecard we are getting, that this time around it's going to be a number that meets in line. So just look at it. 13 the 2 quarters ago, 13 again in the last quarter, and in the second quarter 20 companies in line set of numbers. The weak numbers pretty much have remained stable, and what we're seeing is that a number of companies reported strong earnings have shifted to the inline number. So it's been a very muted set of earnings this time around. So that's the broad consensus we are getting. Just look at the screen, you can just see it's just filled by yellow. Yellow is the meet estimates or inline earnings. What did well was certain auto companies. Cement did well. IT was pretty much in the inline. Banks were in the inline. So these are the heavyweights. IT and banking are the heavyweights. They were in line. Reliance was pretty much in line. So and basically it was the banks which had asset quality issues that actually came into the red. Let's see individually some of the sectors. So basically, Maruti and Bajaj Auto showed strong growth in the margin and margin expansion. So auto pretty much a thumbs up. Ultratech and ACC reported better numbers. ACC is no longer in the Nifty, but we are seeing that it was basically cement that was driven by Ultratech. It was the 4th quarter of strong results that came in by Ultratech. From the cement pack did well as a pack, but overall Ultratech shown. The entire FMCG pack came out with an inline set of numbers. There were no surprises at all as far as this pack is concerned. Let's talk about oil and gas. Now, after 2 strong quarters, Reliance actually slowed down. They reported muted set of numbers. The big highlight for Reliance was the EBIT positive Jio numbers that came out. Lower GRMs hit IOC, and second weak quarter for ONGC also. So oil and gas has been, no fireworks at all. Now banks, Kotak, HDFC, IndusInd, ICICI, all of them met expectations. What was not doing well was Axis Bank and Yes Bank. Now remember, Yes Bank numbers were not bad. It was asset quality that weakened significantly. For Axis Bank, it was bad for both on the financial side and even on the NPA side. Now, this is basically NBFC. Bajaj Finance has been reporting strong numbers, but this time around, inline set of numbers. First set of numbers as the Nifty numbers. Indiabulls Housing Finance continues to show strong numbers. Even for the past few quarters, Indiabulls Finance has been doing well. All the big 4 IT companies came out with inline set of numbers. The 5th one was Tech Mahindra, and that reported strong set of numbers. And Neeraj has been discussing time this again, that the mid-cap IT has done well this time around. Weak guidance was the common theme across the IT sector this time around. Zee, only media company, ad revival growth was seen. Zee reported strong set of numbers, should be good for Bloomberg Quint also, so media channels. Lupin meets estimates but gives muted guidance, so that was weak. Dr. Reddy's came out with a strong set of numbers, but the margin beat was only on account of lower cost controls and lower R&D costs, so the counter didn't do well that way. And well, let's see what else we have. Vedanta, Hindalco in line with estimates. So metals, no fireworks. We're seeing that Metal prices are going up, but the results are not seen. Tata Steel disappointed. European business was very, very weak on the metal front. So basically, this is the broad earnings heat map that we have. It's basically in line. There's nothing much to talk about. It's just yellow all the way. And the heavy weightage counters are in the yellow band. So that's the broad theme that we are seeing in results.
All right, I think we have an expert comment coming in on earnings as well before you want to talk about it. Neeraj, shall we just read it out? This is coming in from Mahesh Nandurkar at CLSA, and this is what it says. The Q2 results season has so far seen more results above estimates, but downgrades are still slightly edging out upgrades. The GST transition slowed the first few weeks of the quarter, but most corporates noticed a pickup towards September, possibly due to the early festive season. We still see 14% FY18 earnings growth, followed by 20% and plus in FY19, as a low base of demonetization plus GST sets in from the December 2017 quarter and will extend for the next 3 quarters. So that elusive earnings recovery remains elusive, if I may say so.
Yeah, well, one, a low base. Now, just 2 points. One, is the sell side now estimating a bit more correctly in this quarter? Because meeting estimates is a factor of what the poll results were, and therefore companies are meeting estimates. The question mark really is if India Inc. has been able to do better in Q2 as compared to Q1. And there, the answer is a yes. I mean, Q1 we had seen, I think, a downtick of 13% earnings degrowth. And that has corrected itself in Q2. So in that sense, the numbers are better than Q1. That is not to say that the numbers are good. But hey, I'm just saying, is the sell side estimating better for a lot of numbers to be
so
in the
yellow? Has performance caught up with expectations? Have expectations caught up with performance?
So yeah, the chicken and the egg.
Yeah, all right.
Yeah. But so that's the interesting one. But I think Q3 will be the key quarter, right? Wherein the low base brings about earnings growth, and then people will then give out the exact number. Because the reason I bring this up is Mahesh is probably one of the optimistic ones who's talking about a 14% earnings growth. A lot of people have scaled it back to 10 or sub 10% for FY18.
They say, I'll believe it when I see it.
Yes, 100%.
All right, switching focus from earnings into demonetization. Well, it's about a year since the government announced demonetization, 8th of November, so almost exactly a year. The debate over what it's done to the economy continues. In an exclusive and rare interview to Praveen Chakravarti, consulting editor at Bloomberg Quid, former Prime Minister Manmohan Singh actually raised a couple of key economic issues apart from the politics of it. He talked about the fact that we need to get our economic priorities right, that it's unclear whether the goal of a cashless economy will actually help private and small enterprises and whether it will help these small enterprises achieve scale. He also questioned whether the end of a formal economy or a more formalized economy justifies all the means to get to it. Praveen Chakravarti summarizing some of the key takeaways from that interview with Manmohan Singh.
This week marks a year since the government announced demonetization. In an interview to me, former Prime Minister Dr. Manmohan Singh speaks about the impact of demonetization on the broader economy and the challenges facing the nation as we look forward. Dr. Singh was uncharacteristically vocal in his opposition to demonetization when it was announced a year ago. I asked him, how would he assess the impact of it now, 12 months later?
Dr. Singh says, and I quote, "Slowing GDP is merely one indicator of the economic damage. Its impact on the weaker sections of our society and business is far more damaging than any economic indicator can reveal." One immediate manifestation of the damage has been on jobs. 3/4 of non-agriculture employment in our country is in the small and medium enterprises sector. This sector has been hit the hardest due to demonetization. Therefore, jobs have been lost and new jobs are not being created. I also worry about the longer-term impact of demonetization. Headline GDP may well start to show an improvement after the recent lows, but rising inequality has been a constant threat to our nature of economic development. Demonetization may exacerbate such inequalities, which can be harder to rectify in the future.
The government has subsequently come out with other objectives for demonetization, such as a cashless economy or a digital economy. I asked him, how important are these as economic priorities for our nation?
In reply, Dr. Singh says, quote, "Objectives such as a less cash or digital economy are laudable pursuits. But we also need to get our economic priorities right. It is unclear that these goals of cashless economy will indeed help small enterprises become larger and achieve scale efficiencies. That should be our priority. These small and medium enterprises are the backbone of India's economy and labour markets. It is unwise to sabotage this sector in some rhetorical pursuit of a digital economy. Any behavioral change cannot be coerced or forced. It has to be nudged and incentivized, as behavioral economists have found. Digital or cashless economy is a mere post facto justification for what was fundamentally a flawed economic policy.
Economic measures such as GST, demonetization are often touted as hard pills that India must swallow to formalize its largely informal economy. Is formalization a necessary condition for long-term sustained economic growth? If yes, what is the best way to achieve it?
Dr. Singh says, and I quote, "The value created by the informal sector will be captured in the form of income, wealth, or consumption effects. Hence, we must be cautious about the sweeping generalizations about the informal economy and passing moral judgments about the entire sector. Having said all this, it is very important for a nation such as ours to build strong state capacity to lift our standards of governance. This is possible only when we increase our share of tax revenues. If formalization of the informal sector means a widening of the tax base, it should be welcomed. But the means is as important as the ends."
Dr. Singh spoke about the importance of institutions. He is also a former RBI governor. I asked him about the impact of demonetization on institutions of policy making and governance in the country.
On this, he says, quote, "The Reserve Bank of India was bypassed and overshadowed in one of independent India's most significant monetary policy decisions. This is a cause for concern. I am not for a moment implying complicity of the RBI, and I am very sure that the RBI did not have a choice. I am equally confident that the governor of the RBI will strive to regain credibility and independence of the institution. But I am very concerned about the creeping culture of erosion of institutions in other spheres."
Dr. Manmohan Singh famously warned that demonetization could derail economic growth by 2 percentage points. I asked him if he feels vindicated now.
"This is not about vindication," says Dr. Singh. He adds, and I quote, "In fact, I strongly feel the time for politicking over demonetization is over. It is time the Prime Minister graciously acknowledges the blunder and seeks support from all to rebuild our economy. There comes certain moments in a democracy's history when economics should take precedence over politics. It is one such moment now in India."
Right, you can go to bloombergquint.com to read more on Dr. Singh's views. That story is up on the website.
All right, that's all we have for you on First Word this morning. Stay tuned, though, to Bloomberg Quint. We're going to discuss the rising valuations of Indian markets with Saurabh Mukherjea of Ambit Capital, the changing demand-supply dynamics in the graphite electrode industry with Ravi Jhunjunwala of HEG. And then we take a check on the e-commerce industry after the festive season. Vishal Mehta of Infibeam will be joining us. We've got lots lined up for you this morning. And with that, Neeraj, a quick look on the markets.
Yes, indeed. A quick check on the day's trade, starting off with Agam, who's standing by with a quick setup of the derivative space. Agam, good morning.
Good morning, Neeraj. Well, we saw the Nifty close largely flat, and that means that we've also seen very little change when it comes to futures open interest, at least as far as the November series goes. As you can see, just about a 0.6% gain as far as OI goes. But on the other hand, when it comes to the Bank Nifty, we have seen a substantial increase in OI of as much as 6.6%, despite the fact that the index has moved down marginally. Moving in, the India Volatility Index has moved up further, in fact up as much as 9%, above the mark of 13. This may be a cause for concern for a lot of bulls, at least in the near term. And with that, we've also seen the Nifty put-call ratio edge up higher to a certain extent to the mark of around 1.55. But when it comes to the change in open interest, as you can see, we have seen substantial amount of activity around the 10,500 mark, where the call as well as the respective put has seen some amount of writing. But you do see a little more resistance build with more accumulation in the 10,600 call. That said, in terms of stock futures, we're looking at 3 securities moving into the F&O band, so Diwan Housing Finance, Infibeam, as well as Wockhardt. We're looking at fresh longs building up in counters such as Nestle India, where open interest has increased by as much as 26%, and shorts in SRF, where OI has moved up by as much as 12%.
Thanks a lot for that update. I'm telling viewers who are tuning in right now to watch Countdown. Every day, I think Navneet has got it on the button at 3:10. The spotting that she does about stocks which may or may enter into the F&O ban or out of the F&O ban. And these are the stocks that we discussed in yesterday's session as well. I was skeptical, she mentioned 4, but 3 of them have actually entered into the F&O ban. So just a small programming note, so to say. But thanks a lot for that, Agam. Abhijit Pathak, Director at Definite Solutions, joins us right now on the show. Abhijit, good morning. Thanks for joining in. Your call yesterday was that if we hold on to those 10,400 levels, you wouldn't mind initiating longs. We did hold on to those levels. Did you initiate longs yesterday? And if so, what should be today's strategy for an average trader?
Yeah, like I said yesterday, as long as 10,400 is intact, Nifty is strong. But for the first time yesterday, we saw some selling around 10,530 Nifty futures. So that will be a point of concern. And something interesting which I noticed was the 10,500 put. The low of the 10,500 put was 101. If that is not broken, that means we will soon go below 10,400, which is the support level. I mean, that is what I am trying to correlate between the put premium and the Nifty level. So if as long as this 10,500 put does not trade below 100, that means it is the other way around. We might go lower. So we need to be careful at yesterday's highs near 10,530, 10,540. And maybe initiate shorts also, depending on where the market closes, because I believe it is going to open gap up. But after that, we might see weakness again.
So when would you initiate that trade on the Nifty, Abhijit? What would be the factor that would determine that?
Yeah, like I said, if yesterday's 10,700 call, it has made a triple top at 40 levels. So I would treat that as my stop loss. So as long as 10,700 call does not cross 40 premium, so that means that is a good level to initiate a short position. So I'll be looking at a 10,700 call, and if it goes towards 30, 35, that is a good place to go short on Nifty or maybe even buy a put. And then have a stop loss of 100 on the 10,500 put, and then go short with a stop loss of yesterday's high on the 10,700 call, which is around 40.
Abhijit, one quick word on a strategy that you have for the day. You're going long on a PSU bank.
Yeah, Bank of Baroda has been strong, and as long as it does not break 168, 169, it can move up again back to, like I said yesterday, all these banks are trading in a range, and Bank of Baroda is at the lower side of the range, so it is worth taking a long. Again, it is results are due in the next few days. So if 168 does not break, it can move up back to 180, 185. So that can be a trade to buy Bank of Baroda on a dip, and with a stop loss of 168 for a target of 180, 185.
Okay, Abhijit, much appreciate you taking the time out and joining us today with your strategies. See you tomorrow, same time. For now, though, let's move on to the commodity space, and Pradeep Pandya joins in to talk about that and take the show forward. Pradeep, naturally, crude is at the center stage.
Definitely, and $57 plus on US WTI crude, and on Brent we have $64 plus levels. So that is really alarming. Yesterday, there were 3% gains on WTI, 3.5% gains actually on Brent. And this is all happening because of the rising political uncertainty in Saudi Arabia. If you look at gold, it has also gained a bit, almost 1% gains were seen yesterday. Interestingly, these gains are also attributable to the rising geopolitical risk that markets are trying to factor in, while dollar has also strengthened, interestingly, in yesterday's trade. Although this morning in Asian trades, if you look at it, dollar has in fact lost a bit versus yen. In fact, the dollar yen yesterday went all the way to 114.75. That was the high since mid-March this year. So a 6 months high on dollar versus yen is what was reported yesterday. I think markets were taking cues from the developments during the President Trump's visit to Japan, where some trade deals are likely to be renegotiated. If you look at the metals this morning, steel trades higher for 6 days. Zinc has snapped a 3-day losing streak, has gone up. Rubber has also traded higher for a second day. Aluminium is the one that is lower for the 4th day. So that could be the only negative indication, as of now. But what's dominated news over the last 2 days is the surge in crude prices, which are firmly lodged at 28-month high. One company that stands to gain a lot from higher prices is ONGC. The upstream major actually gained close to 4% on Monday. And joining us now on the phone line is company's finance director, A.K. Srinivasan. Good morning, Mr. Srinivasan. If you could tell us to what extent have your realizations gone up over the last 1 month or so?
See, for every dollar change in the company, there is an impact of almost 1,000 crores on the top line for a full volume of the production of the 1 year. So if you consider these increases which have spurred recently, this will have half of the year, if it is continuing at the same level, then we can imagine there could be a increase of top line by almost 500 crores, keeping the same volumes what we have anticipated to produce.
So as you said, every dollar increase leads to 1,000 crore rupees impact over the full year on your top line. If you could tell us, is the entire price hike passed on, or is there any subsidy component which is still left?
There is no subsidy at all. We have not been sharing any subsidy at all.
So what was your net realization actually in the last quarter, if you could share with us?
It was 51.27 was the average realization. Vis-a-vis that, if you look at if the crude price is above 60, and I think it was almost hovering in the month of October at 58, 57, and now it has surged to 60 plus. So definitely there is going to be a better quarter coming forward.
Mr. Srinivasan, good morning. This is Neeraj Shah joining in as well. To your estimate, sir, I know it's difficult to guess, but is this rise in crude prices looking like it will sustain? What are your thoughts?
It's very difficult to predict the crude oil prices. No one thought it will cross 60 immediately, but it has crossed 60. And we expect this will continue as long as the Saudi issues are sorted out, and OPEC is also looking at to maintain these levels. So we expect these will go up, but we don't know how long these prices will sustain.
Okay, last couple of questions. I think the last time that we spoke, or last time that the statements came from your end on Bloomberg Quint, the year-end production levels that you had forecasted were about 23 million tons, if I'm not wrong. Do they still stay put, or are you changing them even marginally?
See, let me one thing clarify. I am no more Director of Finance with the ONGC. Okay, I have superannuated on 31st of October.
Fair call, sir. But in your capacity as somebody who has held the office, any thoughts on whether those production levels could change, or you reckon that will be comfortable?
Will continue, which is definitely going to be there at the levels what we have predicted.
Okay.
And we are able to, even in up to halfway mark, we have met our targets.
Fair call. Mr. Srinivasan, much appreciate you taking the time out and joining us. Thanks for being with us today. So that is in his former capacity as Director of Finance, ONGC, of course, Mr. A.K. Srinivasan, talking about it's difficult to predict crude prices, of course, as everybody is, but I think he spoke about how the dollar increase in crude oil prices leads to the uptick in the top line as well as the realizations for ONGC. Seems to be in a sweet spot, 58 or thereabouts for October, about 60. So from a $51 average that I think he mentioned for the previous quarter, the October, November, December quarter could well see an average which could be close to 60 if indeed prices sustain at these levels. Mayuresh Joshi, fund manager at Angel Broking, is with us on the show now. Mayuresh, you just heard the former Director of Finance at ONGC, Mr. Srinivasan, speak about the impact on ONGC. But let's talk about whether ONGC or any of the companies that materially benefit with the higher crude prices are good enough investment opportunities currently? Because it's no longer a ONGC that used to trade at 160 about 4 or 5 months ago. It's at about 119 and almost 200.
Morning, Neeraj. Yes, I think the direct benefit for ONGC is that the realizations that they probably have directly pass on because there is no subsidy and no under recoveries that they probably need to share. Secondly, yes, again, I think the entire street is of the opinion that 60, 65 is probably the range for crude. And if it crosses beyond that, the component of sharing comes back again. But to a large extent, the $51.5 realization that they had in Q2, it's definitely going to go up, which is going to prop their earnings, at least from a Q3 perspective. I think the street is cognizant of this fact. And even in terms of volumes, whether you're talking about oil volumes, is expected to be close to 24, 25 million tons. And again, I think the gas volumes are expected to be around the similar range. With gas prices going up as a basket for the Indian produce, even the earnings on that front are going to be sequentially better than what they have reported. Does that mean there is a paradigm and a significant shift in terms of how the earnings outlook might look? It really depends on how crude moves from here on. But yes, at least from a Q3 perspective, and assuming that crude has stayed at these elevated levels over the next few weeks, I think the positive momentum of these stocks will continue. But again, at this point of time, with the moment that you rightly mentioned, from 160 odd to 200 odd rupees, does it make an investment case? I think one really needs to see how numbers pan out and how the entire macroeconomic situation pans out to make an investment case for ONGC or Oil India at this point of time.
Okay, Mayuresh, stay on, so much more to talk about, but let's take a quick check on all the key results that were reported post-market hours yesterday. Darshan, of course, as usual, is standing by with the earnings heat map. Morning, Darshan. Yet again.
Yet again, it's green, and you know, it's the mid-caps that are doing extremely well. So most of the companies came out with a strong set of numbers. Gujarat Gas and TRF were the only ones that actually disappointed. Let's take a look at some of the numbers that came out. Torrent Power came out with strong set of numbers. The revenue growth was 9%, profit growth of almost 125%. Strong move as far as margins also concerned. The EBITDA moved up 27%. Margins coming in close to the 29% mark. So strong numbers from Torrent Power. The next company is KEC International. Strong set of numbers here, good sales growth of 3%, profit grew almost 38%. Even if you're looking at it operationally, a 16% jump on the EBITDA, and that is why margins coming in the double digit this time around. The next company that we'll speak about is Gujarat Industries, and could pretty much be the stock of the day. Revenues up to almost 3%, profit up 5%. But look at the operational efficiency. EBITDA up 26%, and from 30% it's moved to 37% EBITDA margin. So Gujarat Industries, good set of numbers. You have Gulf Oil Lubricants, 22% top line growth, 30-40% bottom line growth. Even as far as EBITDA and EBITDA margin is concerned, you're seeing EBITDA margins close to the 20% mark. So strong numbers here. What disappointed Gujarat Gas, even though revenues was up 12%, profit saw a drop of almost 12%. Volumes were clearly very, very weak for Gujarat Gas. EBITDA down by almost 3%, and EBITDA margin down to 15%. And the final company is TRF. It's a Tata company. Even though revenues was up 7%, operationally not doing well. Loss actually doubling from 16 crores to almost 32 crores. And EBITDA negative of 37 crores, EBITDA negative margins of 17%. So these were the weak numbers, but overall, good set of numbers by most of the companies that came out.
Thanks, Darshan, for all the details. So we had, we'll probably have more gainers and losers today on the back of strong numbers coming from these mid-cap companies, so to say. Mayuresh, how do you look at Torrent Power? You know, the net profit up 125% to 317. If you look at EBITDA, that is also up 27%. Margins have expanded quite a bit from 24.6 to 28.7, 410 basis point gain on margins. What's your rating on this stock?
No, so the whole rating continues, but yes, with a good and solid set of numbers, I think we need to revisit these numbers. And largely, again, I think the outlook in terms of their financial performance has been quite stellar over the past few quarters. So it has been quite consistent in its delivery. So largely, I think the whole rating continues, but I think we need to relook at these numbers again and then probably re-rate our stock.
Okay. So that's the call on Torrent Power. Let's go across to our research team now and see what are the important stocks that they are tracking, the important numbers really to watch out for would be. First up, I think Cipla. So we are joined by our research team now. Darshan, to begin with, Cipla, how does the number look like?
So it'll be a decent numbers compared to others because it has substantial share in the domestic market, and there will be restocking impact of the GST. Now we are seeing a growth of almost 7% on the top line. On the bottom line, we are seeing a growth of 13%. Margins will come in close to almost 18.8% versus 18%. Now India region is expected to grow well, 25% on a year-on-year basis and 40% on a quarter-on-quarter basis. South Africa is also expected to grow decently in double digits. North America will be slightly muted given the fact that there are issues as far as pricing is concerned, but the other segments are expected to do well. Now on the back of GST restocking that has come in second quarter, India sales will be higher. US business to see a slowdown on account of pricing issue. There were no major launches that happened this time around, and the favorable product mix and higher India sales will probably aid the margins for Cipla this time around.
And I guess expectations from BHAL would be muted.
Yeah, it is. You know, we are seeing revenue growth of almost 2% on the top line. Profit is seen up almost 45%, given the fact there are no new major orders that came in, but a significant amount of old orders execution has started. Margins coming in at almost 4% versus 2.3%. Now, growth on account of favorable base last time around. Execution will pick up in one of India's stalled projects, and reduction in slow-moving orders are expected. Better product mix towards power products or power projects will expect it to improve margins for the company, and there is lower other expenses and better operating leverage which can be seen in BHEL this time around, which will aid numbers for the company.
Well, Agam, just listed stock you are tracking, there was some excitement ahead of numbers if you look at the price movement, but would traders really be happy?
Well, it's a largely mixed performance. When we consider that the top line growth, that's around 7.9%. That's largely in line with expectations, but it's an operational beat. So in terms of margins, they have come slightly ahead of consensus expectations, standing at around 20.4% as against expectations of 20.2%. Consequently, we've seen profits move up 27% at around 37.5. I have two brokerage notes on Just Dial. Macquarie says that, and they have not rated the counter yet because they want to wait for the conference call to get over and then go ahead, but they are of the opinion that traction in paid campaigns will remain elusive, and cost rationalization across the board is a reason why they have seen some amount of increase as far as margins go. And Morgan Stanley, they maintain their underweight with price target of 360. They say revenue growth has not shown signs of pickup, and margins beat is primarily cost led. So we'll wait and watch for how Just Dial opens in trade today.
Okay. Shraddha, what are the other stocks to watch out for in today's trade?
Pradeep, 5 or 6 names, starting off with Tata Chemicals, where they have sold their phosphatic fertilizers business for 375 crores. Now, this had been in the offing for a while now. The Tata Chemicals wanted to exit the fertilizers business. You also have Muthoot Capital, where the QIP book was launched yesterday to raise about 200 crores. And according to the mandate copy, the price band was set at 601 to 610. Now, that's a steep 7% discount to yesterday's closing price. Mercator is also launching its QIP with a floor price set at 44.65, about 1% premium to yesterday's closing price. Reliance Communications will continue to remain in focus. Now it has entered into a MOU to sell its DTH operations across India. Now the sale consideration hasn't really been shared. Axicades Technologies, Engineering Technologies, they are looking to acquire a Bangalore-based company for 175 crores. That's Mistral Solutions. Now, at the price of 175 crores, Mistral Solutions has been valued at about 1.3 times its revenues. Sagar Cement is yet another company. They have shared their October month data. Cement production is up 15.5%, while sales are up 24%. So we should see some positive reaction on the back of those numbers. So all of these stocks, Pradeep, of course, apart from your ONGCs, OMCs, and all the oil-linked stocks like aviation, paints, etc.
Well, thanks, Shraddha, Agam, and Darshan for all these details. Mayuresh, your call actually on the oil stocks, both the upstream and the downstream oil marketing companies. How are you positioned right now?
So Pradeep, I think with the movement in crude that you're witnessing at this point of time, the upstream companies' positive momentum can very well continue, and with net realizations expected to be much higher compared to Q2. I think Q3 results will be far better than what we'd witnessed. So yes, I think the positive momentum on upstream stocks will definitely continue. For downstream companies in particular, I think the kind of statements that the oil minister has given, the marketing margins seem to be holding on. With the kind of capex that they have done, for example, HPCL embarking upon a 60,000 crore capex, BPCL is doing a 1,08,000 crore capex. And if you look at even IOC, 1,80,000 lakh crores. So I think that's a significant capex that they're putting on to put in new capacities, good Nelson complexities, which means that the refining margins should hold up in the near future. The cash flows remain extremely strong, and this entire equation embarks upon the point of crude staying below 65 and the dollar moving within a range. So I think the sensitivity to earnings, both in terms of these two key variables, are extremely critical for OMCs. So I think the hold rating on OMCs continue because I think the earnings momentum might very well continue. The rub-off effect that you'll probably see on stocks like a GAIL or a Petronet, GAIL more or less a midstream kind of company. I think the transmission lines, the expectations of tariff revisions have clearly worked out in terms of earnings expectations being up. So I think the hold rating on these two stocks continue. But the flip side with higher oil prices is going to rub off negatively in terms of how margins might pan out for a lot of these crude derivative consuming companies, whether that be paints, you're probably looking at tires. So I think you might just see some negative sentiments playing out on these stocks and sectors.
Okay, Mayuresh, stay on. So much more to speak about, but let's get in our technical experts on board and try and figure out how are they approaching trade today. Hadrian Mendonca, Senior Technical Analyst at IIFL, joins us on the show, as does Jay Thakkar, Assistant VP for Equity Research at Anurati. Gentlemen, both of you, good morning. Thanks so much for joining in. Hadrian, you've been missing. All okay, I hope. Start off with what would you believe is a trade on the index today?
Yeah, Neeraj, definitely all good. And, as far as the Nifty is concerned, I think we can continue to, go long or even hold on to your long positions. Talking about the Nifty, it's consolidating around the 10,450, 10,460 zone. If you see, since the Samvat lows, Nifty has built strength each and every day it has gone into trade. In the past 5 days, you've seen Nifty hitting all-time highs almost every day. But this consolidation phase the Nifty has entered into is raising a little bit of skepticism, in the short run. See, the only cause of concern for me here is the rising trendline resistance zone, which is being built since if you join the peaks of 2008 to 2015 and till date, you'll see the rising trendline coming exactly around the 10,450, 460 zone. So that is something that we should watch out for. Definitely the trade is long. So every long position should be protected with a stop loss of close to 10,385. Because if the 385 level is broken on a closing basis, we may see some kind of selling pressure emerging in the short run. But for the while, definitely long is the trade in Nifty. Okay.
Jay Thakkar has some very interesting strategies, and we'll go to him in a bit as well as Hadrian's strategies. On CET and JSW, but it's 8:50, so that time of the show wherein we get you our special segment, which is Bloomberg Edge, wherein Sumit Sarkar today tells us about a pattern that the terminal has thrown up on the stock of DCB. Sumit, what is the terminal telling us about DCB?
So the fear and greed signal is suggesting a buy signal on the DCB today. Now the fear and greed indicate, what is it, the fear and greed indicator? Now it is the spread of two weighted moving averages of true range, and it oscillates on a zero baseline. Now if you see the chart, it turns green. It turns green on a buy signal and red on a sell signal. Now currently on DCB Bank, it has turned on green signal here.
Okay. If you zoom in on the chart, I think, and then Sumit will be able to explain to us better, at the lower end of the screen, I think there is a series of red and a green tick. Sumit, I think you are referring to that.
Here, if you see here, it has turned green after a series of red, and after a very long, that's around after 15 days, it has turned green for DCB Bank.
Okay, so there is a buy signal for DCB. Sumit, just wondering if you've been able to test the efficacy of this over the last maybe 6 to 12 odd months?
So over the last 1 year, after backtesting the data, it shows that if one would have followed the buy and sell signals according to the fear and greed indicator, then it would have given the investor returns in excess of 40%.
Okay, thanks Amit for all these details. So DCB is a stock which has given a positive signal, a signal of bullishness on our Bloomberg proprietary indicator called Fear and Greed. But Jay actually is looking to buy a PSU bank. Jay, what's your strategy this morning?
Hi, good morning, Pradeep. Absolutely, I think that Nifty Bank clearly has provided a breakout, and we have been quite bullish on the same since it has broken the levels of 25,200. In fact, we were bullish already, but then with the break of 25,200, it has confirmed the breakout from a flag pattern which has a minimum target of around 26,700. Now we have seen that since prior to this breakout, it was led by the recapitalization news, wherein it got some movement in the PSU banks, and thereafter, even though we have seen a breakout coming in the bank Nifty, the PSUs haven't moved much. They have in fact gone sideways. Now in this consolidation phase, we have seen Orient Bank in fact forming a good symmetrical triangular pattern, and in yesterday's trading session, it has managed to provide a breakout on the upside from the same, along with the momentum indicators giving a buy crossover on the hourly charts as well, which clearly indicates that the probability of this stock now resuming its uptrend, the fresh up move, is quite high. The minimum target in fact comes to around 145 and thereafter 147.50 in the short term, so we recommend to buy this with a stop loss of 140.90, which is in fact the lower end of the symmetrical triangle pattern.
Okay, and Hadrian, what would you like to buy?
Yes, CEAT is looking pretty interesting. In fact, if you would have noticed, the tire stocks were back with a bang yesterday, and you saw a lot of tire companies making a comeback. So CEAT is one stock that we are pretty bullish on. In fact, after consolidating for over 4 months now, that's a long time of consolidation. In a one single day, we have seen a very strong up move. Volumes have been incredible. Other oscillators are indicating a good, strong crossover with a positive bias. Interestingly, all the crucial, moving averages have been surpassed in a single day after yesterday's move. So the overall setup is indicating that this momentum will definitely continue forward, and we are seeing a near-term target of close to 1855 and keep a close stop loss of 1760 on the downside.
Jay, the other interesting one is persistent. You don't normally see this come as a trading strategy. Why, it's not a trading stock really. Why persistent?
Yeah, I agree to some extent, because this has been a slow mover. In fact, if you compare to the other IT stocks, which clearly provides the kind of momentum, or most of the time they remain in the momentum. But then persistent in the short term has been consolidating again in a symmetrical triangular pattern, like the one which I just discussed as far as OBC was concerned. The patterns are quite similar, and I think the move prior to this consolidation was an impulsive move, and it seems to have completed the final leg of the consolidation. Hence, the probability of a move from here on increases. The indicators which were quite oversold are now turning into a buy mode. So I think that on the lower side, one can place a stop loss at around 640.50 and target around 682.50. I think that risk was definitely favors the bulls from here on.
Okay, and Adrian, I believe, unless I'm very wrong, you've spoken about CEAT, but JSW Steel is the pending call.
Yeah, I'm sticking with stable and an index heavyweight. So JSW Steel is something that we are really bullish on. Metals, along with the tires, have made a comeback in the past 2 days, and JSW Steel has been consolidating for almost 3 to 4 weeks now. So after a long consolidation, we are seeing price moving above the higher end of the overall trading range. So I think one can consider buying JSW Steel even at these levels. You can see a short-term target of close to 275 to 278, whereas keep a stop loss at 265.
Okay, the other set of stocks, Mayuresh, which have been on a roll, have been some of these PSU names. Maybe ever since Dredging Corp announcement came in, but Hindustan Copper, MMTC, STC. And these stocks have a tendency of getting into a flare and then cooling off. Would you view this move as yet another example of the same?
Might be, and the probability still remains high on the side that you're probably envisaging at this point of time. So I think one really needs to be selective within this PSU space, have an approach where the earnings visibility looks very, very strong. So yes, I think the stocks that you mentioned, the spaces that you mentioned, I think one really can perceive this to be one move where if something disappoints, I think the sell-off can be equally sharp.
Mayuresh, have you been tracking Gulf Oil lubricants? The numbers are excellent, so to say. EBITDA up 41%, margins from 16.7 have come to 19.2. It's huge gains on margin, actually.
It's been a margin improvement factor, and again the entire variable here becomes how base oil probably moves. So I think it moves with a lag effect. So if crude is moving higher, the price increases in terms of raw material push through will also come with a lag effect. But having said that, I think not tracking that actively, but again, Castrol is something that I track. I think market leadership position, good moat. So yes, I think the space looks interesting, but Castrol is something where the positive bias still continues.
Okay, I think less than a minute to go for the markets to kickstart trade, but no, actually a minute and a half. So Mayuresh, let me quickly ask you, what is it that you would be comfortable buying? I think you've discussed a couple of names, but we missed out 1, 2 or 3 days ago. What is it that you like currently?
So the PSU banking space is on a roll, Neeraj. At this point of time, as I said, I think the base working in favor of them. And largely, again, going forward, the entire thesis of recapitalization should work favorably in terms of both accelerated provisions actually getting some amount of cushion, as well as credit growth picking up marginally over the next few quarters. So I think Vijaya Bank is something that I would consider as a dark horse candidate within the PSU space. It has posted a very good set of numbers. So if you look at the NII growth in excess of 20-odd%, GNPAs reported were 7-odd% compared to 7.3 on a quarter-on-quarter basis. Net NPAs at 4.86 compared to 5.24 on a quarter-on-quarter basis. And on an absolute basis, the GNPA is still on the higher side. The softness and the lumpiness in earnings will very well reverse over the next few quarters. So again, I think Vijaya Bank is something on declines in a staggered way that I will continue to like within the PSU space. Indian Bank was my favorite, but that has moved up significantly.
Okay. So let's see how markets really react to all these significant numbers, and the ones which are yet to come. Supply and BHAL would be the most important numbers being watched out for. Let's look at Asian markets. They have opened positively, and the Q for SGX Nifty is also positive. First time above 10,519. Yesterday, we in fact went on futures side above that mark. So let's see what happens today. 10,445. Surprisingly, it opened flat to positive, and then there is some pressure now building up. Well, what's the side now? 10,418. Sensex, on the other hand, is actually looking positive, up 50 points. So there is a bit of divergence between Sensex and Nifty, but these are early minutes.
Yeah, probably early minutes of trade. So let's wait and watch what happens there. The Nifty Bank could be an interesting one too, but we're likely to start off slightly higher if the SGX Nifty was to be believed 10,000, above 10,500. So let's wait and watch or in the future side at least. So let's wait and watch for those. 3 or 4 earnings that I thought need to be highlighted. One of them was Torrent. I think it came out with a fairly decent set of numbers, you must say. So let's bring up Torrent Power. Let's bring up 10%. Let's bring up Just Dial. That's the other interesting one. And I think the markets would be it would be heartening for investors in KEC International. Quite frankly, for these companies, the order book is not a problem. But if they can execute the same order book at better margins, which is what KEC has done in the quarter gone by, then that is positive news. Let's wait and watch if there is some more traction out here. Gujarat Industries is the other one, which came out with a fairly decent operational performance. So that is something you need to watch out for. Lastly, I just want to mark certain private sector banks. We are talking about DCB. There is a JM Financial note that has come in on DCB, Federal Bank and City Union Bank. Let's see if those stocks have some reactions today, as also some of the stocks which are entering into the F&O band. So Diwan Housing, Infibeam, which has been on a roll, and Work Hard. Those 3 names will be on top of my list as well at about 9:15 or thereabouts. As well as the currency, Pradeep, that started trading too.
Yeah, so in fact, dollar has been gaining some strength, and the impact on rupee, if you look at it, 64.63, which looks a bit weak. 64.61 is what we get now. So it's actually strong. Interestingly, rupee is doing really well. 64.50 is the level really to watch out for, that forex traders have been talking about for a while. And let's look at some more stocks. Shri Pushkar Chemical is one. This stock has been buzzing in now. Promoters have bought some shares from the market. So if that stock has really traded with significant volume, what's the move? Only 1.5% so far. So not much. We'll try and spot more mid-cap and small-cap stocks buzzing in today's trade. But Somit Sarkar joins us with the big brokerage calls of the day. Somit.
So on brokerages today, we'll see the JM Financial's note on 3 mid-cap private banks. Now the first is on DCB. Now they have initiated coverage with a buy rating and a target price of 230, which suggests a potential upside of 27%. Now increased synergies and efficiencies will drive the fee income growth for DCB Bank, according to JM Financial. Now they're expecting the cost ratios of the bank to come off a bit, which will improve and which would result in earnings CAGR of around 25% over the next 4 to 5 years. Now they're expecting the bank's return on equity and return on asset to improve to 15% and 1.24% by financial year 2020 from 11% and 0.9% in financial year 2017. Now consistent growth, healthy net interest margins, improving operating cost and strong asset qualities are the positive for DCB Bank. Second is on Federal Bank. Now they have initiated coverage with a buy rating and a target price of 140, which suggests a potential upside of 21%. Now Federal Bank's focus going ahead will remain on sweating its existing assets after the expansion plans, and this will in turn turn around its return on asset ratio. Now the operating costs and the credit costs are also expected to come off, which would in return boost its return ratios, and the company's return on and the bank's return on equity and return on asset is expected to improve to 13% and 1% by financial year 2020. Also the net interest margins are expected to remain in the range of 3 to 3.1% over FY18 to FY20. The third is on City Union Bank. Now they have initiated coverage with a buy rating and a target price of 185, which suggests a potential upside of 13%. Now they're expecting the margins, that is net interest margins, to come off slightly because of higher competition in the market. However, for deposits, they're expecting that to remain stable and grow at a compounded annual growth rate of 15% over FY17 to 20. Going forward, they're expecting the credit cost to come off over FY18 to 20, which will keep earnings on an improving track for the bank. City Union Bank is a healthy compounding play with a greater bottom line visibility over the medium term, according to JM Financials.
It should be interesting, some of these mid-sized PSU banks. Thanks a lot for that, Sumit. Mayuresh, would you go lower down the pecking order on private sector banks, or are the larger ones providing enough growth for you to have comfort there?
No, so Neeraj, I think the corporate-facing banks, I think over the next few quarters, as more recognition happens, both in terms of reported NPAs and provisioning as well, I think the credit cost should start tapering down. And again, the kind of emphasis that they've laid on retail advances, I think it should definitely lend a support to their growth. But with the lower private sector banks, BCB and Federal is something that I own. So my own sense is that the kind of growth prospects that one can expect from these banks, both in terms of an advances growth and again the cost staying lower, which basically means that the yields that they probably are reporting should be probably healthy going forward as well, and that will create a multiplier effect in ROAs and ROE reporting over the next few years. But again, I think Karur Vysya banks look very, very interesting. If it declines, the kind of patchiness that one saw in its credit growth in the year gone by, I think that should very well reverse over the next 2.5 years. And a similar premise, the yield should probably get maintained around 7.7, 7.8 in terms of reported NIMs. And largely, again, I think the ROE and the ROA expansion should be quite significant. So our own expectations is ROA should come down or come back to those levels of 1.3, 1.4, and reported ROE is close to 15, 16%. So any decline, I think, becomes a very good buying opportunity in Karur Vysya. But disclaimer, I think I own all these three banks.
Okay. Mayuresh, looking at the numbers, do you think just Dial's business is kind of stabilizing? Because there is definitely operational improvement, as our research team had also pointed out earlier.
No, again, Pradeep, I think the kind of investments they've done over the past few quarters and the kind of hyper competition that they were facing, that had a toll in terms of reported numbers. But largely, again, for businesses like these, I think you should probably have time by your side, because if you let time pass by, I think the competition will just wipe you away. Yes, I think you've probably seen stability in numbers taking place at this point of time. But largely, again, I think consistency in terms of reported numbers and improvement in cash flows is something that I very, very keenly look out for in terms of making an investment case. So unless I have a couple of quarters consistent numbers getting reported, and again looking at how the competition intensity pressure is probably weighing on in terms of their overall business model, my own sense is that to make an investment case out of Just Dial at this point of time, at least at our end, is not a viable option.
Okay, just a couple of stocks that I want to mark. They've been on an uptrend like never before, and a few other stocks have such moves, but HEG and Graphite India, from the looks of it, will have another day in the sun. 5% higher for HEG, that's 2028. Graphite India 634. This is just an unreal rally that we're seeing in both of these names. And the management of HEG will be joining us a bit later on in the show to talk about whether there is fundamental earnings trajectory, if not reportage. The reported numbers are extremely strong, but whether that can continue or not. So Ravi Jhunjunwala of HEG would be joining us a bit later on in the show to talk about this. It's just been one heck of a rally. And I really can't take a technical view out here because I think both Hedren and Jay Thakkar will say the stocks have done really well. But a very quick thought from you, Mayuresh. HEG or Graphite India, what's the house view? Would you buy them?
No, I think phenomenal move, but largely again I think the utilization level specifically in case of Graphite or HEG has to be clearly monitored from an FY19 perspective. A clear perspective if the management does come through, I think needs to be asked in terms of coke needle prices, because they have moved up significantly. So what happens in terms of both prices as well as the shortage that you're probably looking at as a key raw material that these graphite electrode makers use is going to be very, very key. But the oligopolistic nature for this market as well as the global shortage will have a very positive impact, and the reported numbers are exhibiting that. But Graphite India, I think, what, 12-13 times EV/EBITDA, I'm not too sure whether that makes a very positive case in terms of valuations. But I think these two factors is something that I would keenly ask the management in terms of working out my numbers for FY18 and 19.
We'll do that, Mayuresh. You can tune into the conversation at about 9:30 a.m. on our side. Okay, just minutes away actually, but a quick thought really here from Hedren. Hedren, any of the mid-cap real estate names that look attractive to you? Kolte Patil yesterday nudged those 52-week high levels. I suddenly saw some of the others too moving up. Anything in that pocket that looks interesting?
I think I'll go with HDIL. You know, the stock is showing very good signs of, gaining momentum. For the first time, it has crossed above its 50-day moving average and also surpassed its 21-day moving average. So the current momentum and the volumes that we are seeing is on an increasing mode. Secondly, the short-term target over here on HDIL is coming close to the 65-66 levels. But it is very important it manages to hold above the 61 mark. So yesterday we saw a close above 61 pretty convincingly with good volumes. So I think HDIL is something that a short-term trader can consider going long. If you see a holistic view, HDIL on the weekly charts has done something very interesting. If you see the chart from 2015, the start of 2015 till date, HDIL has been oscillating in a very restricted manner between the 55 and the 80 levels. So for the first time, the stock has once again entered into this restricted zone of 55 to 80. So a close somewhere close to 61 is pretty strong for HDIL going forward. Even if you have a perspective of 3 to 6 months, HDIL would be a good bet from here on. So short term as well as medium term traders or even delivery buyers can go ahead and go long on an HDIL.
Okay, so short term, medium term, long term, or whatever, long term from a technical parlance, Adrian believes it's a good stock to buy. But just 4 minutes away, let's tell you all that you need to know to stay ahead in trade today. Strong results by Torrent Power, Just Dial, L&T Infotech, KEC International, NRB Bearings, Gujarat Industries Power, as well as Gulf Oil Lubricants. And these stocks should react today.
Well, Gujarat Gas and TRF report a weak Q2, while Thomas Cook reported earnings that met estimates.
Cipla, BHEL, Castrol, Future Retail and Thermax are all a set of stocks which will report numbers today.
HDFC Standard Life Insurance IPO opens today. Issue price has been fixed at 275 to 290 rupees per share.
JM Financial initiates coverage on mid-cap private banks, sees 27% upside in DCB, 20% in Federal Bank, and about a 13% upside in City Union Bank.
And Diwan Housing, Infibeam, and Wockhardt are the stocks which enter the FNO band today.
Okay, so we'll watch out for all of these names and more, but from the looks of it, those PSU names will start off on a good note. ONGC, by the way, will start off above 200, so do note that stock. I was just looking at the broader end of the spectrum. The likes of MMTC and Hindustan Copper will start off on a good note too. And both the Gujarat-based power companies, Torrent Power and Gujarat Industries Power, after reporting good numbers, will start off on a good note as well. So do watch out for these names. Mayuresh, any interest here? Torrent Power, Gujarat Industries Power?
So as I said, I think Torrent Power, I think the whole rating continues, but we definitely need to relook at our numbers to probably revise our ratings. GIPL has been one under-researched stocks, both in terms of the potential that it probably carries and the kind of valuations that it probably are deriving at the current book value. It's a very, very interesting story, Neeraj. I think you need to give time. So I think if one is a patient long-term investor, I think this stock can really compound your returns over the next 3 to 5 years, but one really needs to have patience in terms of how the company will report its numbers.
Jed, what's your call on RCF? The stock was a late mover yesterday, is up today 3.5% so far in pre-open.
Well, I would say, Pradeep, this is one space wherein we have been, consistently bullish, and especially, fertilizers, and RCF was one of my pick. I would say, I would still suggest that one can still continue to hold this if someone is really having it. And for the short-term traders, I would say that recently the stock has provided a very clear breakout from a falling wedge pattern. It has managed to move above its short-term moving averages as well. And the support now on the lower side is packed at around 91. So with that as a stop loss, one can definitely target 110 on the upside.
Okay. Hadrian, quickly, what's your top pick this morning?
For a pure momentum play, I'll go with KPIT, the mid-cap IT. It has been in a very strong momentum. Along with CNN and JSW Steel, KPIT is something that I would, bank on and ride the momentum as long as, the trend does not turn around. So I think we can keep a stop loss of close to 152 and, target for close to 162 to 164 in the short run.
Okay, KPIT from Hadrian. Jay Thakkar, 10-second answer. Your top call for the morning.
I think, Ultratech Siemens, the stock has clearly provided a breakout from a falling channel, and the target on the upside comes to around 45.65. On the lower side, one can place a stop loss at 43.50.
Okay, markets have started. Gentlemen, all three of you, thanks so much for joining in. But this is how the markets are kick-starting trade today. The Nifty 10,476. The futures could be an interesting trade, maybe nudging the 10,500 odd mark. Sensex about 72 odd points. The Nifty Bank is starting off on a good note, about 1/3%. So not a bad start for the Nifty Bank as well, giving a bit of a support, but nothing too dramatic, just about status quo. Let's get individual names up on the screen and the heat map actually. Let's first get the heat map on and see if indeed the color of green is overpowering. Yes, indeed, a fair bit of green on the screen. Very little red, I might add, even though the index is just up about 1/4%, and therefore there won't be too many dramatic moves. Just 2 or 3 names that I want to highlight on the big screen out here. One of them is ONGC. The second one is HPCL. 2 names that I want to highlight as a result of the crude price uptick could be very, very interesting. So let's get those individual names on the screen. One of them is ONGC, about showing a tick of about 1.5%. HPCL down about 1%. ONGC should come up on your screen. 3% higher, 204 and counting. So this would be levels that ONGC has not seen since January 2017. Strong moves for this one. And lastly, the auto names which are very quite abuzz yesterday. Tata Motors or a Maruti, I don't think they're starting off in the same vein today. Tata Motors I saw was amongst the top losers at the start, down about 1%. Some newsmakers in the session today, and I think we should get in some individual names out there. Result reactions being seen for some stocks, and for some names, I think they're just on a roll. So earnings reaction being seen for Torrent Power, not Torrent Pharma really, Torrent Power and Gujarat Industries Power. JIPCO is up about 142, so good going there. A strong Q2 for Just Style. The stock may have run up a bit, so just about flattish. L&T Info is the other one, which came out with a reasonably strong set of numbers, and this one is up about 2 percentage points in the session today. What else? New highs, new 52-week highs, if not life highs, for HEG and Graphite India. These stocks continue their merry ways. We'll, of course, talk with the management of HEG a bit later on in the show. Monday buzzers. Remember, these stocks did extremely well in trade yesterday, and almost all three of them, well, MMTC certainly so. STC, not bad really, but this one, 7% odd, doing okay. I think the one that is not moved in line is Hindustan Copper, but still up about a couple of percentage points. Lastly, stocks which have entered the FNO band today. We highlighted this pack yesterday. DHFL, Infibeam and Wokhard. Wokhard is starting off with a bit of a red. Pradeep, what else are you spotting?
Three stocks, AstraZeneca Pharma that opened up around 8% has moved on to 13% now. So additional buying of 5.5% on screen. Orient Paper was other stock that moved up by 5% on screen, again is up 6% in total if you look at it. And Island FS Investments is a stock that has gained around 4% on screen again, which is up around 6%. These are some interesting stocks that actually saw buying after opening higher. So this is interesting. Goa Carbon would be another gainer with interesting volume, so to say. And SJVN is yet another mover. So these are some of the stocks which have been doing well in early trade today.
Okay, a special guest. We'll keep on marking some of the stocks which are moving around. I think oil and gas prominently the theme out there. But a special guest on the show today, Saurabh Mukherjea, Chief Executive Officer at Ambit Capital, joins us right now on the show. Saurabh, good having you as always. Thanks for taking the time out. I'm looking at your thoughts that you've shared with us, Ambit Capital thoughts and exhaustion signs visible in the market. Why do you believe there is exhaustion? Is it, I mean, and what are the signs that are leading you to believe that the market could be tiring out?
I think whenever you see a big surge of QIPs after a long upward rally in the market, whenever you see a big surge in QIPs, and especially QIPs from less than ideal companies, it does raise some questions about the quality of the rally and the quality of the paper coming to the market. So it could well be that we have an earnings turnaround round the corner, but at this juncture it does feel like we have an overstretched market, overstretched on the valuations front. And whilst, as we've been saying over the last 3 weeks since the banking recap was announced, whilst there's reason to believe that next year growth will pick up, GDP growth will pick up to around 7%, and earnings growth next year might well be the first year in 5 years of double-digit earnings growth. Even considering 15% earnings growth next year, you got a market which is pretty fully valued, more than fully valued, I would say, and hence the view that from a fundamentals perspective, you got an overstretched market, and on the quality of paper coming to the market, especially on the QIP front, you got some really smelly stuff hitting the market.
You're talking about QIPs, but if you look at some of the recently listed IPOs, in fact, these have been some companies waiting to enter the primary market for a long time. Some of the leading companies in respective sectors like insurance, mutual fund, or even retail. Are you really worried about the quality in the primary market on the IPO front as well?
I think the primary market, the IPO activity has been sort of mixed. You had a few good companies mixed with several ordinary ones. What is noticeable is high quality B2C, high quality manufacturing companies. We haven't seen that many. I think since that memorable DMart IPO, there are not that many names come to mind as really frontline plays on the manufacturing segment or the B2C segment. Good news is on the life insurance front, we've had several stellar champion players in life insurance come through. So if you ask me, IPOs is a mixture of mediocre and some really high class names. But the QIP front the QIP names do look worrying. These are companies which have been trying to raise money for a while. The fact that they've got a window now to raise money and they're sort of obviously printing the dollars as quickly as they can, it does raise the question as to about the quality of paper hitting the market. Alongside that, you've got overstretched valuations, a little less overstretched than before the PSU recap, but even then, barring a remarkable pickup in earnings next year, barring a sort of absolutely miraculous pick in earnings next year. You've got an overstretched market. Alongside that, for reasons that India can't control, oil is picking up. Oil picking up, going through $60 is always a concern for us because of the impact that oil has on our economy, given that we import almost all of our oil.
Yeah, you preempted my next question, Saurabh. You combine valuations, politics, and macros really well. Two factors that I wanted to ask you about. One, the crude oil uptick. You gave a brief, but if you can elaborate there as to at what levels would crude start really concerning you, if not already, and what facets within the market would really be at risk, if at all. And two, there's of course this very interesting political arena game, so to say, over the course of the next 35 or 40 odd days. How would that play a part in market mood, if at all?
I think last time I was on your channel, I remember that was the day, or the preceding day, the government had cut excise in order to compensate for the rise in the oil price. So the oil fuel is still deregulated in our country. Petrol and diesel is deregulated, which means that dollar for dollar, the rise in crude will, with a 2-month lag, hit our economy. And given that we've got 14 elections in the next 17 months, it'll be a big test of the government's conviction on the reform front, whether to regulate oil. If oil goes through 70, if crude goes through 70, and this government doesn't bring subsidies back in, I think it'll be a huge sign of their commitment to reform. So fingers crossed on that front. I think that's a big test that's coming up. Crude going potentially through 70, and India being asked a question: do you still want to keep deregulated oil going? But the broader piece is, if you look at the last couple of years, we've pulled off something which is quite miraculous. You had GDP growth falling for 6 quarters. You had falling interest rates, and in spite of that, both on the bond and the equity front, FII money has come into India. That's never happened before. Falling GDP growth for 6 quarters, falling interest rates, and in spite of that, lots of FII money, bond and equities. That's a one-off. The reason we pulled that off was inflation was low, and inflation was low because commodities were cheap and the fisc was under control. Both of those factors, commodities and fisc, could go the other way now in the next couple of years as we approach the 2019 elections, and hence I think it's worth being circumspect on overall market positioning. Yes, I do agree that the recap of the PSUs does give you a chance to play cyclicals. Excluding BFSI, I think cyclicals will have a decent run as global commodities rally. But at the overall market level, I continue to believe we have a fully valued market.
But interest rates is the factor that most of the analysts have been mentioning whenever we talked about stretched valuations. You are actually hinting at a resurgence of inflation, but do you think it's going to be significant enough for RBI to really think of a rate hike going forward? Because I think the consensus view is that we are in a stable interest rate scenario. Maybe a cut in future if things kind of turn in our favor, but hike is something that nobody's talking about.
Well, when people don't talk about something, when consensus is blindsided about a risk, that's when you should focus on the risk. But to put it in more practical terms, as I was saying, the reason we've been able to keep inflation at around the 3-4% mark, CPI inflation, is because we've been helped by the commodity cycle, and we've also been helped by a government which has been fiscally prudent. So a lot of credit to the NDA. First 3 budgets for fiscally conservative, prudent budgets. But as we all know, the fisc is under a degree of pressure now. GST collections are below par. The PSU bank recap bill, unless the RBI picks up the PSU bank recap bill, the PSU bank recap bill will stretch the fisc on any normal definition of a budget deficit. So if you look at a stretched fisc plus the PSU bank recap plus rising commodities, it'll be absolutely miraculous if CPI didn't start pushing towards 5%, given all that backdrop. And hence, I think the conservative investor, the cautious investor, should start seeing this as broadly the bottom of the rate cycle. Maybe just in a really exceptionally positive circumstance, we have one more rate cut. But I think the odds are growing in favor of rate hikes rather than cuts over the course of 2018.
Calling it early, maybe. Okay, Saurabh, I probably have one final question, really. I was just looking at all that Ambit Capital has come out with in terms of thoughts over themes and sectors. And that one that stood out for me was your recent turning bullishness on select brokerage stroke NBFC names. Now, we've had the three large listed players come out with the results. The market correction has come in maybe because of higher valuations, but I think there was a common theme across all three discussions that we had, was that all three mentioned that the growth rates that they have showcased in Q2, from the looks of things, could well last out until FY18, maybe even beyond. The question mark only sort of to my mind is whether the valuations out here too are stretched or no. What would your thoughts be?
I think, look, if you were to take the market as a whole or even brokerage stocks, it's unquestionable that on a 1 year view, even 1.5 year view, I think we are fully valued in this country at the moment. The difference with brokerage stocks, which doesn't apply to the market as a whole, the difference which does apply to the really high quality brokers, especially those who have very little NBFC business in their book. I do worry about brokers who also try to become NBFCs. I don't think they have any business doing it, but that's their prerogative. But if I look at brokers who don't have big NBFC housing finance books, the reason I like them is I think real estate in India is heading for a major correction. We've already seen a correction in real estate prices across the big cities in the last 3 years, but with growing evidence that land price deals are being struck at cut price rates, and with anywhere between 4,000 to 7,000 companies in the NCLT process, I think we can look forward to a major correction in land prices, and by one remove real estate prices next year. So therefore, given the increasingly grim outlook for putting money in property and land, I think increasingly Indians will shift to putting money into the financial system, for which the brokers would benefit. Does that necessarily mean a stock price rally for the market as a whole? I'm not so sure, because lenders account for 35% of the Nifty's weight. No sector ever has accounted for 35% of the Nifty's weight, and I think the rally in lending stocks is overdone. But brokerage companies, wealth management companies in India, I think have a long growth runway ahead of them as Indians stop saving through physical, land, real estate, and increasingly save through financial assets, bonds, equities, mutual funds, and so on.
And what's your take on the overall consumption story? Auto is one prominent sector that has been doing well. Select names at least have kind of outperformed market expectations. What's your view going forward?
I think on consumption, the big unknown that we're trying to assess is, has there been in effect a stealth GST cut, in the sense that at the lower end of the spectrum, the 1.5 crore and below turnover companies, are they really paying GST or are they basically operating in broadly tax-free regimes? Tax-free, obviously not de jure, tax-free de facto. And if that's the case, if for the small trader, for the SME below with 1.5 crores and less of turnover, if the GST regime is lax, slack, etc., then I think through the winter consumption could pick up. But it's still hard to gauge it, partly because every weekend these GST rules change. So the business community itself doesn't know, that even the chartered accountants aren't fully on top of what's happening. But if, given the imminence of 14 elections, the fisc decides to take it easy on GST collection, then I think SMEs might well be able to drive consumption through the winter, as they realize that GST isn't that much of a horror show that they thought and we thought it would be.
Okay. On that note, Saurabh, always a pleasure talking to you. Thanks so much for taking the time out, and we'll watch out for that caution as well as the rate cycle trajectory as well. Look forward to having more often on this forum. That's Saurabh Mukherjea, Chief Executive Officer at Ambit Capital. Just a quick thought really on a word on the markets. Fairly flat day for the large caps. ONGC is that big mover in trade, though giving it companies Gale, so that's not doing all that badly. And amongst the broader end of the spectrum, AstraZeneca is at a big move today, 12% higher. MMTC is up 7%, 10%. But watch out for two stocks, NBCC and Engineers India. For a really long time, in about 2015 odd, they used to have a common trajectory. They used to move in tandem. Both of these stocks are up about in the session today. Let's wait and watch if there is more in store. But for now, take a very quick break. Up next, we speak to a stock which is just not letting go of the gains. HEG and Graphite India, of course, both of them have been moving. We speak to Ravi Jhunjunwala of HEG and take stock of the graphic electrodes industry, and a bit later on, the e-commerce industry with the festive season with Vishal Mehta of Infibeam.
Are we live?
Welcome to programming that's insightful, authoritative, and at your fingertips.
Bringing news alive. So immersive, so new, and so addictive. You will want it no other way.
The Bloomberg Terminal, accessed only by over 325,000 marquee investors across the world until now.
Business news, we're news for business people.
Watch us live in conversation with Ramdev Agrawal as we talk about the power of price.
Market is very, very competitive, and now there is a FI market, there is a DI market, and the bucket is same. What is the right price? I mean, at what price you should buy, and how do you tackle this overvaluation, the problem of overvaluation right now? Should you avoid buying?
Watch us live in conversation with Ramdev Agrawal on the 7th of November at 11 a.m. as we talk about the power of price in the process of investing. Send in your queries using the hashtag AskBQ to BloombergQuint.com. Write to us now. Use the word Ramdev in all your queries. Thanks for staying with us on Indian Open. Now, the steel capacity shutdown in China has shifted the demand-supply math in favor of Indian steel makers and, in turn, graphite electrode makers in the country as well. To add to it, the higher share of steel production through electric arc furnace and the graphite electrode industry is in a very, very sweet spot. Joining us on the show today to talk about how sweet is this sweet spot is Ravi Jhunjunwala, Chairman and Managing Director at HEG, a company that will benefit from this changing demand-supply dynamics. Good having you, Mr. Jhunjunwala. Thanks so much for joining in. Now, what is known over the last 2 or 3 odd months is that the demand-supply dynamics for the graphite electrodes industry has improved. I believe the demand used to stay at 7 million tons per annum. Now the supply, because of the Chinese situation, has come off to 7 million tons per annum as well. Is this likely to be the driving factor over the course of the next 6 to 12 odd months, or could this change as well?
You see, nobody can predict the future, but it seems like a basic structural change. What has actually happened is, in the wake of the crackdown that the Chinese have been doing on some of the polluting industries, they've closed down about 120 to 140 million tons of what they call induction furnaces and some mini blast furnaces, which have been highly polluting. So what it has done is Chinese capacity to export steel has come down substantially. China was exporting about 120 million tons of steel to about 200 countries in the world, which is now likely to drop to somewhere in the region of 60 to 70 million tons. So that 50 million tons, which is now not being exported, is obviously being produced in those countries which were up till now importing. So that has added to the demand of electrodes. Secondly, China was also exporting a lot of billets, and to that extent, these countries were not able to produce their own billets. They were importing at dumping prices. So that has also substantially come down. And thirdly, in addition to the steel capacities which have been shut down in China, they've also closed about 30-35% of their electrode capacities. So obviously the demand has certainly shot up. It has taken everybody by surprise, including us. We never expected something like this to happen, and happen so quickly and so fast. So basically, it's a structural change. I mean, it's anybody's guess if some of these capacities are able to come back in China or not able to come back. But for the time being, it seems that most of these capacities are gone forever. And we just recently heard in the last 24 hours that it was known, but we heard the action yesterday that we all live in Delhi, so we know what pollution is in the winter, and the winter 3-4 months are the worst period. So it was also already expected that they will have a second round of crackdown on in the winter months, where the pollution becomes even worse. So according to some reports which have been published yesterday, it seems that that has begun, and some of the areas where these capacities were still operational, they've cracked down on that, and so it is likely to close more capacities of steel, which in turn would mean less and less exports. And to that extent, a lot of these countries which were not able to operate their steel plants at optimum capacities are now able to do that. And it has happened at a time that the last 2-3 years for the electrode industry have not really been good. And following that, about 30, I would say 25 to 30% of the electrode capacities outside of China have also been closed because we didn't need those capacities anymore. So the electrode capacities have come down, and on the other hand, the electrode demand has certainly shot up. So obviously, that has created a strong imbalance in demand supply. And that has led to the situation where we are today.
Mr. Jhunjunwala, keeping with the theme that Neeraj introduced, the consolidation that you're seeing on the supply end, can you tell us how you're making the most of it? And I know it's difficult to explain how long this will last, but how is this changing your client profile, if any?
No, it is not changing our client profile. You see, we have been absolutely the last new entrant in this field about 40 years ago. So it's a technology-oriented industry, and so there have been no newcomers, let's say, in the last 41 years. And in the last about 20 years or so, India has become a fairly significant player. In fact, it would not be out of place to say that every incremental demand of electrodes anywhere in the world in the last about 15-20 years has been met by India, which basically means that in the last, let's say, 20 years, India has been expanding capacities for the electrodes, and our exports have been growing year after year. While the other 3-4 players, there are only 3-4 other graphite companies in the world, so they have actually shrunk their supplies. They have been shutting down their plants over the last 20 years. At the same time, India has been expanding. So it's fair to say that every incremental demand anywhere in the world has only been met by India. So obviously, we are a significant player, and any change which happens anywhere in the world has an impact on us, positive or negative, whatever it is.
What was your capacity, Mr. Jhunjunwala? You had the excess capacity to be able to meet this shift in demand, and what are you operating at now in terms of capacity utilization?
We were operating at about 60-65% last year. This year we are likely to operate anywhere between 80 to 85%. And like electrodes, where technology is an issue, our major raw material, which is a petroleum-based raw material called the needle coke, coming out of some refineries, that's also a technology area where there are only 3 players in the world, one in US and 2 in Japan. So that landscape has also not changed. So over the last couple of years, the supplies of needle coke have become a little scarce because as the electrode industry was suffering, so was the needle coke industry. So they worked with some lithium-ion batteries in China's, and there has been some movement of needle coke to China from US and Japan. which has now found a new application in the lithium-ion batteries. So that has created some sort of a imbalance, I would say, just like we have in electrodes, where the needle coke supplies are in short compared to whatever we need. So that's the reason why more or less every one of us, let's say the 5-6 companies in the graphite in the world, we are all, none of us are able to operate at, let's say, 95 or 100%.
So you're essentially saying that there is only up to a point that you will be able to capitalize on this situation where capacities in, say, China are shutting down, because your ability to ramp up may not be that significant because of these back-end linkages which you were just pointing out.
Yeah, exactly. And that is a situation with the entire graphite industry, not just alone HEG or other Indian company, but this more or less applies equally to everybody.
A lot of your sales is shifted to now the spot market.
Talking about the capacity.
Go ahead, Mr. Jhunjunwala.
You see, traditionally in this industry, there has been a tradition that some of the very large customers in the world, including India, have been buying on an annual basis. And those contracts are normally signed and agreed in the beginning of the year. So this year was exactly the same. And by that time, at least the graphite industry had no clue about what was to happen in the next 3-4 months. So going by that tradition, we and everybody else did sign some long-term contracts. And those tonnages, those shares of the long-term contract versus the short terms or the spot sales are coming down sequentially. So what I said yesterday in our investor call was in the first quarter of April, June, while practically 100% of our supplies went at old prices, it started coming down as we start dispatching more and more of the spot sales or the new price sales, as you call it. And over the next 2-3 quarters, our share of high-priced sales will keep increasing. And to that extent, obviously, the realization will be better. Our profitability should be better.
Okay, so actually that's the question that I wanted to ask you. On a 6-month basis, your reported numbers, your revenues have shown a 70% uptick. Now, that is arguably also because of a low base. And I'm not even getting into EBITDA and PAT, but I just wanted to understand, for the next 18 months, the next 6 months, you'll have the benefit of a low base. Post that, for FY19, would it essentially be a realization-led growth? And therefore, would these numbers taper off from these high 70-odd% revenue uptick that you've seen in the first half?
See, in the next, let's say, if you're talking of, let's say, year March 19, it'll be a mix. There will certainly be an additional growth due to volumes. We do see some easing of needle coke situation happening over the next 12 months. So we do think that we should be able to produce more. We do think we should be able to get more needle coke. And the pricing should be, I mean, the average pricing, let's say in 18-19 should be higher than at least what we are having right now, because we are still suffering with the impact of the annual contracts, as we just spoke about. So our average prices, as I said, in January, in April-June quarter was 100% old prices, which obviously had a big drag. And in the current quarter that we just announced our results, that share has come down. So we have started selling now at a part of our sales at higher prices, the spot sales, as you call it. And that number will keep increasing. So it will be, I can assume very easily that our average prices should be higher in 18-19 compared to this current year of 17-18 on an annual basis. So it'll be revenue based as well as volume based.
So I have one final question, sir. Since you've described the sweet spot, but the trapped sweet spot that you are in at this point in time, you've stated that you are confident of being able to maintain this huge jump in margins or maintain margins at this elevated level over the course of the next several quarters? And that's entirely predicated on the back of the shift to, selling in the spot market. Do you see anything disrupting this margin picture over the course of the next few quarters?
See, for the next 2-3 quarters, I really don't see that. I mean, I can clearly see, based on whatever discussions we are doing right now for the next 6 to 9 months. I see the prices, if not going up, we should be able to maintain. And as I said, as we start depleting more and more of our old price orders, our average keeps going up. And so I think the current margins that we are talking about, we should be able to maintain, if not improve. Now, it's very difficult to say how much improvement it could be, but my guess is that it is safe to say that at least we'll be able to maintain, if not improve.
All right, Mr. Jhunjunwala, we appreciate you joining us this morning, and thank you for that insightful conversation on what's going on in the graphite electrode industry.
Thank you.
That is ATG for you. Let's move on to the next company we're talking to this morning. Cheap credit and discount offers boosted sales this festive season, both for brick and mortar stores as well as for e-commerce players. Was Infibeam able to tap into this festive demand? Is that what's keeping the markets happy with the stock? Let's find out from founder and CEO Vishal Mehta. Good morning, Vishal. Thanks for joining us here at Bloomberg Quint. Quite evident in my introduction was the very first question, and that is, how have the past few months in terms of sales been for you? And then I have a question more on the structure of your business, but let's get on with the festive demand point of view.
Sure. See, generally in Diwali, which is the festive season, you always see a jump in terms of the overall volumes, much like it happens in offline retail. Online retail, of course, it's still in the infancy. If you look at online as a percentage of overall retail, it's still very small. But, as far as the expansion is concerned, it is, growing at a very rapid pace. So if you look at the festive season, I think it was, of course, in October. And, so as a result, you will see that, Q3 for most companies, both in offline and online retail, potentially becomes very large. You would see some impact even in September month as well. Specifics, of course, we will be disclosing in terms of our quarterly results. Having said that, as far as the consumption story of India is concerned, as well as online, e-commerce is concerned, it is very large. And we believe that that trend is expected to continue on. More and more consumers adopting online formats, as well as, with the proliferation of, devices, as well as internet penetration through aggressive plans with, telcos and many others, that we expect that more and more consumption potentially moves online. And as a result, a lot of offline formats potentially become hybrid formats where they offer both offline as well as online, access for consumers to purchase products. As far as, you mentioned our business model is concerned, you see our business model is more B2B today, which means that we provide infrastructure and software frameworks.
Vishal, if I may interrupt you there, I'm so sorry to do that, but your services business has fared far better than your products business has, and I think I was later on in the conversation going to get to the question of, do you really want to be, many things to many people as opposed to just one focused thing, because it just seems as if your services business is doing much better, whereas it comes to the hyper-competitive e-commerce business, you're not quite up there on the top of the heap.
You're right. So basically, it's very important to understand the business model that we have followed. And you mentioned that services has been growing significantly for us, and that has been a huge cash cow for the business, which allows us to build a very strong balance sheet and P&L. So let me maybe spend a minute or so talking about our business model, and that potentially answers your question about, what happens to the product segment. You see, we have continued providing infrastructure and software as a service to many of the retailers and brands. And today we've got more than 70,000 odd merchants utilizing our framework. We had a subscription model whereby we get paid. And that also includes retailers both in domestic as well as international markets. Recently, we've also signed up Government e-Marketplace, which is a government initiative to build out a marketplace where central government procurement also moves through it, where we were awarded a contract as part of the consortium where we are providing the core e-commerce engine. So you see, that is about 7 lakh odd crores in terms of the central government purchase that potentially moves. And if you go to, a government e-marketplace website, you will see real-time stats in terms of how much procurement is happening through those, opportunities. So we have a software and infrastructure vertical where we are an enabler and not necessarily a single destination where people have to come and shop. And that has been a core revenue driver for us. And in the last few months, we've also, through the merger of CC Avenue, moved from just not subscription, but also transactional volume. So we make money out of every transaction. Last quarter in Q1 of this year, we processed more than 4,500 crores of transaction volume. And the company earns a small portion out of every transaction. So if you look at a run rate basis, we process more than 18,000 crores of transactions. So not just the subscription revenue from the merchants, but we also added a transactional piece where we make the revenue out of every transaction. So that accounts for our service revenue. And that has been a core driver, that has been a focus of the company for the past several years. So rather than positioning the company as a single destination or an e-commerce URL.
Explain to me, why would you not then just focus on what seems to be a fairly lucrative, well-established services business for you, as opposed to continue in a products business that is hyper-competitive, a big cash drain, and in which you don't fare very well on any of the metrics, and which has not been providing you as much growth?
There are two things. One is that we have continually focused on supply chain of the tail, the product tail, which means that when you have very, very high velocity products where there is a huge flow through, that potentially people go to larger marketplaces. And most of the times brands as well as retailers, they find challenges in terms of managing the product tail. And what I mean by product tail is the set of products which don't account for a huge volume. So our positioning there would be that can we aggregate the tail and generate demand where the margins are potentially much better. If you look at our supply chain business and logistics, with the introduction of GST, that we have a very strong thesis on how that potentially changes. And we are building out our logistics format also to be able to capitalize on the introduction of GST, which allows us to keep on expanding our framework and grow to the next format. So our opportunity in terms of the product segmentation is not necessarily just to show very high revenues, which potentially have zero margins or a very negative margin, if you will, for many of the e-commerce companies. What we have focused on is when we talk about products, we build out supply chain and logistics formats. Today, it is not revenue generating for us, but we have a very strong thesis in terms of how that potentially changes with the introduction of GST. And the company is planning to expand the logistics format to several hundred cities. It is enabled through our technology formats. So we will still be asset light compared to most of the other companies that potentially operate in this space. But we think that if we focus on the supply chain of the product tail, which is the aggregation framework, and keep on offering our platform to very large brands and retailers, that this opportunity of product segment becomes very accretive. You will keep on hearing more about what the company does in the next few quarters in terms of how to potentially synergize both offline as well as online formats to be able to capitalize on the product.
Okay, so Vishal, having spoken about all of these, and afraid paucity of time, so getting straight to the point, the addressable market is large. You'll figure out what works best for you over the course of the next 1 year, at least, if not more. What's the quantum of growth that you can show? Because your reported numbers look good. The addressable market size growth is fairly large too. What would Infibeam do? I'm not getting into specifics because I know you still have your results to come out with, but give us a broad gauge picture. Do you think over 100% growth bottom line that you've shown for the quarter is something that you can repeat for the year at large or for FY19 as well?
So you see, as far as the company's focus is concerned, we are of course focused in terms of building out a very strong merchant business through our services portfolio. Today we have got 70,000 odd merchants on our framework as of first quarter. We believe that with new opportunities like government e-marketplace and many others, you will see reported numbers like 45,000 odd merchants already signed up on that marketplace. It's alive and running as of today. So we think that we have a framework where we can keep on adding merchants and keep on growing that portfolio, which results in higher revenue base for us. So we think that the services contribution of our business today is more than 60%. That potentially continues on, and we'll keep on growing the absolute base, which has very, very high EBITDA margins of more than 50%. So we think that that will continue on as we actually scale up our framework. The second piece, which is the transactional piece, which adds to our service revenue. If you look at last year, the total processing volume was 12,000 crores. It is very important to understand this is not GMV. This is processing volume that results into net revenue for us. It actually helps the company build out a bottom line. So we believe that if last year we processed 12,000 crores and this year on a run rate basis, if it is at 18,000 crores, we believe that that potentially adds to our revenue base, and that as demonetization and many digital initiatives will drive more merchants to transact online, that potentially becomes an opportunity for us to monetize upon. And we believe that as we build out even opportunities like government e-marketplace,
right,
with 6 to 7 crores of transactions going online, that results in a better bottom line for us.
Okay, Vishal.
We believe that.
Okay, I got the answer, Vishal. 10-second answer. I'm on your site. It says Infibeam Festival offers up to 82% off. How do you make money if you give 82% off?
It is actually merchants giving many offers.
Yeah, no, I'm just kidding. But it's a great festival offer, Vishal. 82% off is fairly alluring. I'll go to the website and start shopping after the show is over. Thanks so much for joining us today on Indian Open, and look forward to talk to you post your numbers as well. It's Infibeam, guys. 82% off.
I'm still confused as to why they're so gung-ho about their products business, and if the services business is doing so well as they've just claimed, and they're earning every transaction
and the numbers are showing
on every website that they've helped put up, and 60% of their revenue at this point in time, and it's clearly not as high a cash burn business as the product side of the business, then why not just specialize in that? I mean, last quarter they were talking about building out their entertainment and education platform. We didn't get a chance to talk to him about that, but tough to be so many different things to so many different people. But maybe they'll make a success of it.
Yeah,
all right, we're going to wrap it up then on Indian Open there. Up next is the FNO Show. Stay tuned.